Every trader gets that aha moment, right? That flash of insight, a pattern you swear you keep seeing, a great new idea for a strategy. But let's be honest, the biggest hurdle isn't coming up with the idea, it's proving it actually works. So today, we're going to build the blueprint for doing just that, turning your hypothesis into a strategy that's backed by solid, data-driven evidence.
So, you got this brilliant idea. Maybe it's a new angle on market gaps, or you found a unique mix of indicators. The big question is always the same. How do you know it's not just a fluke? How do you test it, really put it through its paces before you risk a single dime of your hard-earned capital?
Well, the answer is backtesting. It's really just a disciplined way of taking your trading rules and running them on historical data. You're basically simulating how your strategy would have played out in the past. Look, it's not a crystal ball, but it's probably the closest thing a trader has to a time machine.
Let's really lean into this idea. I want you to think of backtesting as creating a blueprint for proof. It's just like how an architect wouldn't dare start building without a detailed plan. Well, as a trader, you need a backtest to prove your system's design is sound. This is how we build with data, not just on a hunch.
All right, step one. Any good blueprint starts with the right raw materials. And for us, that means getting your hands on high-quality historical data. And I can't stress this enough, the quality of your backtest is 100% dependent on the quality of your data. This first step is absolutely crucial.
Now here's where it gets interesting. You actually want realistic, maybe even a little bit messy data. So for the gap reversal strategy we're using as an example today, a system that literally hunts for price jumps, we need data that captures all the nitty-gritty details. That means, at a minimum, 30-minute price bars showing the open, high, low, and close. But most importantly, the data must show the gaps. None of that smoothed-out, perfect-looking data. We need to see reality, warts and all, right down to the exact start and end of each trading day. Okay, so we've got our materials. Now it's time to translate our idea into a super precise set of instructions. This is the part where we turn that what if into a strict, repeatable set of rules that a computer can follow perfectly thousands and thousands of times over. The key here is to leave zero room for ambiguity. You've got to break the strategy down into its core components. For our gap reversal system, that means coding 5 key things. First, a trend filter to figure out the market's general direction. Second, some simple logic to spot those price gaps. Third, rules for how price interacts with some calculated price bands. Fourth, we need to define what a rejection candle looks like. That's our confirmation signal. And finally, the really specific stuff. Exactly when to get in, where to put your stop loss, and where to take profit. And this just shows you how beautifully symmetrical the logic can be. For a buy setup, we're looking for an uptrend, a gap down to that lower band, and then a bullish candle to seal the deal. The short setup hits the perfect mirror image. We're in a downtrend, price gaps up to the upper band, and we get a bearish confirmation. You have to code both sides to make sure you're testing the strategy in every kind of market. Okay, so the computer has done its job. It's run our rules over years of data and spit out a mountain of simulated trades. But, data without any interpretation is really just noise. This is where the scorecard comes in. We need to use some key metrics to measure the results and figure out if our blueprint is actually any good. These 4 metrics right here give you a fantastic snapshot of performance. Your win rate tells you how often you're right. Simple enough. But that's not the whole story. The profit factor tells you if your winners are actually big enough to pay for your losers. Max drawdown? Man, this one is so important for your own psychology. It shows you the absolute worst losing streak you would have had to stomach. And finally, average risk to reward. This one shows if you're making more on your wins than you're losing on your losses, which, let's face it, is the only way to succeed long term. But hey, we can go even deeper. We don't just want to know if it worked, we want to know where and when it worked best. So, by breaking down the results, by analyzing the distribution, we can see if the strategy did better on certain products, or maybe on a specific day of the week, like Tuesdays, or maybe we find out that the long setups were way more profitable than the short ones. This is how you really start to find your edge.
All right, we're at the final step in our blueprint, creating the report. This is where you pull everything together, all the data, the metrics, the charts, into one easy-to-read document that tells the complete story of your strategy's performance.
A really great report tells a story, so it needs a clear structure. You want to start with a quick overview, what you tested and over what time period. Then, hit them with a performance table, just the hard numbers. After that, the equity curve, which is that powerful visual of your account's journey over time. It's also so important to be honest about the drawdowns, the really tough periods, to understand the risks involved. And then the grand finale, your key observations. This is the so what of the whole entire exercise.
And this is the kind of powerful insight that makes this whole process so incredibly valuable. This isn't just a number, it's actionable intelligence. A simple statement like this tells you exactly where you should focus your energy and your capital, and maybe what you should avoid. It's the difference between a raw idea and a truly refined trading plan.
So there you have it. The process is clear, and the blueprint is now in your hands. Every trading idea you come up with is really just a question. And the amazing thing is, the historical data is just sitting there waiting to give you the answers. The only question left is, are you ready to stop guessing and start building your proof?